as you guys are making your way on in here, I'll do one plug before we get started on our next session here with Jeff. But for those of you that were in here for the last session talking about office, there is an article. I think most of you guys get the Due Diligence magazine, and there is an article that's in here on the repurposing of office buildings. And make sure that if you haven't gotten your copy mailed to you, that there are some that are, I think, up front at the reception desk. So
That's it.
Oh. So let's go ahead and get started. Let me introduce you, do a quick introduction to Jeff. Meet Jeff DiModica. Jeff is the president of Starwood Property Trust. Jeff has been with the firm since 2014 in the role of president. Prior to that, he was an external director of the company dating back to its inception in 2009. Jeff sits on the investment committee of all of the different parts of the business, which I believe in total within Starwood Property Trust side add up to about $28 billion of assets under management. Jeff's consistently ranked as one of the 10 most important people in commercial real estate finance by Commercial Observer. And Jeff, we're thrilled to have you here. Thanks so much for making the trip up from Miami for this. I'm going to ask you before we start talking about slides. A lot of people know about Starwood, but there's also a lot of people that ask me, hey, weren't you guys the ones that got bought by Marriott a couple of years ago? So I want you to take a couple of seconds because I think it'll set the stage for everybody that's in here as we go through and we talk about different topics. Walk them through Starwood Capital Group and Starwood Property Trust, and so that they have a good understanding of the purview that you have in all the different businesses that you sit.
Yeah, thank you, Steve, and welcome everybody. Appreciate the opportunity to be here. I was a hard no on coming to Orlando on a Thursday in the middle of the winter until I watched Swamp Kings, and that was awesome. And so now I'm a massive Gators fan. Let's go. Super excited to be here. You'll see me in the fall. I have the privilege of being president under a guy named Barry Sternlicht, who a lot of you might know, who started Starwood Capital Group in the early 90s. Barry started Starwood Hotels just before that and left Starwood Hotels as CEO, which was the largest hotel company in the world where he brought it to in 2006 to focus on Starwood Capital Group. Within Starwood Capital Group, we have $115 billion of real estate assets under management today. About $30 billion of that is on the debt side. Steve mentioned $28 billion in Starwood Property Trust, the public mortgage REIT, the largest commercial mortgage REIT in the world, the best performing commercial mortgage REIT in the world, knock on everything, for the last 14 years since we started it.
And the only one, right, that has generated a positive total return since COVID? Is that right?
Listening to the earnings call last week. Yeah, since before COVID, we're up 21%, and the mortgage REIT index is down 19%. So we've outperformed by about 40%. And there's a bunch of reasons in that we'll get into. We run our business with much lower leverage than our peers, and we've been able to cut our office exposure in more than half since before COVID, and that's treated us really well. But we'll talk a lot about office. Office is worse than you guys have been hearing today from where I sit, and I'll get into why I think that, but I think it's going to be a while. So on the equity side of our business, we have $85 billion or so of equity real estate under management. 15 or 18 of that is in a private REIT called S-REIT. Most of you have heard of B-REIT. That's the big sister where we started this from. It's a core real estate equity business. In our much bigger business is our opportunistic CRE equity business. That's our opportunity funds, and we have about $70 billion of assets under management. Globally, almost 40% of that is invested outside of the United States, and we're raising our 13th fund, which we hope will be $10 to $12 billion, and we're having our first close in the next couple of months on that.
All right. So.
Oh, let me say one other thing, though. Within the public company, Starwood Property Trust, that I'm responsible for day to day, we have a number of different lending verticals. So we're going to talk a lot about CRE lending, and that is our core business. But we have $6 billion or so of residential loans that are mostly securitized. We have energy infrastructure loans That's a really good business today. We can get into that if anybody cares to hear more about energy infrastructure. We own a business called LNR, which owns our commercial mortgage-backed securities, CMBS originator that Steve is one of our senior people at. That business also houses the largest special servicer in commercial mortgage-backed securities called LNR, and we buy B pieces and subordinate CMBS securities there. We also own some real estate, and now we are starting up a middle market lending business, and we just started a solutions business, which maybe we can get into a little bit later.
Which is, in LNR in and of itself, to put it in context for people, LNR is named on the special servicer on, I think, close to $100 billion worth of commercial real estate. That's not even included in the numbers that Jeff was talking about in Starwood Capital Group and the Starwood Property Trust side of it. So
yeah, we've managed
it's unique.
Out of $88 billion of defaulted CMBS over the years, and we have $98 billion that we're named on today, and we have $7 and change billion that we're working on today within our special servicer. So we're seeing a lot of the distress that's coming through.
And we call Miami Beach home, which is unique from a couple of years. That's, we did it before it was in vogue.
Yeah, Barry moved down here in 17. I followed him soon after. Moving to Miami has been great for us personally, great for my tan, okay for my golf game. Professionally, it's been interesting. We're doing a lot more here. I think 11% of my lending book is in the state of Florida. My U.S. lending book is in the state of Florida. When you're in a market, you just know it better, and we've been able to make some decent decisions there. It's interesting though, a lot of CEOs are moving down. We live on Miami Beach. It's become a place where a lot of our friends are, and that's great. We have 800 or so employees, 300 and change work for me in the public company, and of the other 500 or so that aren't in Miami, we offered all of them when we came down here in 2018, you can move to Miami and live with us and work with us. And out of 500, I love Florida. I'm a big proponent, and I know this is a very bullish Florida crowd, but I think that's an interesting stat. 2 people out of 500 chose to move their families from the Northeast to Florida. And, the common thing I heard is they didn't have any attachment to it, but the schools and the wives didn't want to leave to come to Miami. So I think the Miami miracle is more CEO-oriented to date. And I'm a little bit worried that if the managing directors and vice presidents of other companies are like Starwood's, that it's going to take a while and we might be building too much luxury multifamily rental in South Florida. But hopefully the kids come. The reason you're going to come is great schools. Great schools give a reason for really smart kids to want to stick around. And the University of Florida becoming so much more important, and Miami becoming so much more important is great. But I think we have to get the education thing a little bit better.
We're the only ones dressed like this on Miami Beach. Everybody else is in thongs and rollerblades, and we're the only ones that look like this that are out there. So should we get started and roll through some slides? All right.
I really hate slides, so we're gonna blow through this pretty quick. Everybody here, we had a wonderful economist 2 speakers ago, and I saw a lot of it. Everybody knows that the federal debt has gone up to $34 trillion. I don't know why this looks like it stops a little bit short of that, with $1.7 trillion deficits the last couple of years. And this obviously shows you CPI and what it did. And the Fed chair has a very difficult job. His job is to use one instrument to solve for 2 things. So he needs to use the Fed funds rate to solve for employment and solve for inflation. He's not solving for the fact that $34 trillion, 1% is $3.4 trillion. And, excuse me, I said that wrong. 1% is $340 billion, right? So if rates go up $340 billion, you have a $6 trillion of expenditure economy, and only 1.7 trillion of that is discretionary spending. So 200 basis point rise, you have 680 billion, or about 40% of that is going to get eaten up in excess interest expense by the government. So unfortunately, the Fed chair is not supposed to think about that, but we all should. And we're in a funny market where everybody in my world in real estate wants rates to be lower. Many people need rates to be lower. For 30 years, I've had a few different jobs, some in investment banking, running mortgage-backed securities, trading desks, and when everybody wants the same thing, it tends to not happen. So I'm a little bit afraid that the forward SOFR curve, which is telling us that short rates are going to come down, may be wrong. And I think the public markets have really missed watching forward SOFR over the last, I'm going totally off script, I know you're going to get some questions, but I'm just going to go. I think the public markets have missed watching forward SOFR over the last year and a half. SOFR is the new LIBOR, for those of you who don't work in the floating rate world. And it's become very important. You know, if we go back to before the GFC, most real estate was owned by pensions, insurance companies, sovereigns, and people financed them with 10-year fixed rate loans. And the GFC happened. Everybody's boss told them they were terrible at what they do, and we're going to give the money to Blackstone, and we're going to stop managing it ourselves. And it's ubiquitously Blackstone. We have a slide in a little bit that's going to show you the growth in private equity and the growth in private equity real estate. And so when ubiquitously the private equity firms took over investing in CRE, they have 5 to 7 year funds. They don't want to borrow 10-year fixed rate with lockouts and with prepayment penalties. So the world went from being a fixed rate borrower to a floating rate borrower. And then this rate rise happened. Our Fed chair had one tool, a blunt instrument coming out of zero interest rate policy to fix these two things. And his only choice was to go higher, and the immediate effect was a very negative on real estate. We all know what happened. But it's a big negative on real estate with floating rate loans, and if it was 15 years ago, it wouldn't have been as big of a negative. If we have 2 years of high rates behind us, a year of high rates in front of us, that 3-year period would have only affected 30% of loans before the GFC, when almost everything was fixed. Almost everything's floating today, and it's mostly because of private equity. And so in the floating rate world, for those of you who don't play in it, a floating rate mortgage is typically 3 years with 2 1-year extensions. We call it a 3-1-1. So I have the option as a lender to let somebody extend into their first and second extension year. But we wrote record amounts of loans in late 2020, all of 2021, and some of 22. And we wrote a lot of office loans before COVID. Those got extended through COVID because they were struggling in COVID, and we've now extended those out to 24 and 25, and our record amount of originations that we did in 2021 are going to expire in 24 also. So going into 25, any lender, any bank has the ability to really push their problems out by taking in a little bit of money and allowing the problem to sort of come to this point, this tipping point in 2025. And why I say that we're at a tipping point that I've never seen. Forward SOFR is today expected in 2025 to be at 3.6 or 3.65% as a low. My stock as a proxy for what people think of floating rate lenders is around $20 a share. In October of this year, when we were at the highs in rates at 5.10 on the 10-year before the big rally in the 10-year, SOFR was expected to be 4.65% in 2025. And in May of last year, it was expected to be 2.7%. So 200 basis point difference, and now we're sort of in the middle. And given we as lenders lend at 65 to 70 LTV, we've given up a lot of our cushion because cap rates have widened 30 or 35% as rates have gone up. 4 caps in multi have become 5.2 caps. I can go on down. In office, nobody knows what a cap rate is because nothing's really trading. It's probably more than that. So every lender in the world who's on the floating rate side has gone from having 30 to 40 points of cushion in their loans to having very little cushion in their loans. This is why where forward SOFR ends up in 2025 is so important. I gave you a stat in May of last year. My stock was at 20 and SOFR was 270. In October, SOFR was 470, my stock's at 20, and today it's at 20. The public markets have got this wrong because my stock should have been a lot higher when forward SOFR was going to be 2.7, and it should have been a lot lower when forward SOFR was 4.6. Because the outcomes, now that I've given up the cushion, are going to be very different. And for the first time in my 30-year career, 50 basis points difference in that forward SOFR in 2025 is going to make a significant difference on the profitability of all of the lenders in our space. So where rates go is more important than it's ever been in my career because everything is coming to a head to the same time period, 200 basis point range, everything's good, everything's terrible, we're in the middle of it, and we'll see where it goes. There'll be varying degrees of terrible. I only have 10% US office. I'm by far the least levered, and we've always run the least levered business of all of my peers. So we're going to be fine. We've massively outperformed, as I said before, because of that. But lenders won't. And they're going to take back a lot of keys. And we're going to get into talking about office. But when they take back keys, it's a big problem for the office next door who's trying to hang on, because that new guy with the lower basis can offer half the rent. So we can sit here and say that an office building at 80% leased with a decent amount of WALT only needs to pick up another 10%, so I'm going to hang on and throw some dollars at it. He's not getting those 10%. Those 10% are going to the guy across the street who, after the bank takes it back and then sells it at a loss, can offer half the net effective rent, can give him more TIs and LCs, more free rent, and ultimately it's going to be really hard for legacy. Now, the guys who spoke about office before, they were completely right. A office is doing fine. A office in great markets is great. But our problem's in B office, and we have more of it, and it's everywhere. And I think that we will not know for 2 or 3 years how this ultimately plays out, and it's going to be difficult for people to hang on, because I think the new leasing activity will go to the new lower basis and things get worse before they get better. So we're all bracing. We're hoping that Chairman Powell sort of bails us out in some way, but we're being super proactive to do things as lenders to reduce future funding, obviously get down on office. And the banks in general have taken large reserves over the last year and a half. I've taken reserves that I think feel extremely sufficient for this market. We'll see where it comes out. But anybody who thinks that that there won't be large losses in office portfolios is very wrong. Barry, my CEO, was on no, he wasn't. He was at a conference at Fontainebleau, but he got quoted for it a lot. A couple weeks ago, he thinks $3 trillion of office is now worth 1.8. That there's been 1.2 trillion of value eroded. I think he's right. I think he might be light. I think it's just more difficult in the seat where I'm sitting, seeing the competitive landscape. We're really fortunate to have assets in every market. We have data going back 40 years, and there's just not a lot of discussions about rent growth, and I don't know where that comes from. And I'm eventually going to let you ask me a question, but this work from home thing here in the U.S. is a big problem. We have international portfolios; they're performing great. Our office portfolios outside the U.S. are fine. People actually go to work outside the U.S.
Tell them about rent growth in Europe. Pick Germany, for example. Compare that to here in office.
Yeah, I mean, you have infill cities that have been around for thousands of years, and it's not as easy to put up a new building or to go just outside of town, and it's not really a suburban office world when you get over to Europe and Asia. And we've seen rents hold in. Work from home lasted, 6 months longer than it did at Starwood, which was 1 week, but it lasted 6 months. Yeah. And we have some buildings in DC and in Arlington, Virginia. I've always loved lending in DC. We have no exposure in San Francisco because tech is volatile, and I'm a lender. I don't get an equity return if it works out really well. I get my dollar back with some interest. New York is volatile for financial services and other, but I don't have the desire to take on volatile markets. DC was never really a volatile market. The government always puts people in the office, and I sort of loaded up a little bit on DC, not that much, but we have an outsized DC exposure versus our other stuff. And DC is the worst market in the country. The government's still not back to work. There haven't been real GSA leases signed in years. I was on with guys from the FDIC a couple of days ago. We're 4 years in, they're working from home. And not everybody. These people like to say that they're in 3 days a week, and somebody up here said, it doesn't matter if they're in, they're still paying rent. Well, guess what? They're gonna take less space when it rolls if they're not going in, if they're not using it. It's not good. So until the government who spent $1.7 trillion in this chart twice, who's created this inflation, who then stepped on our throats by raising interest rates at a historic pace, and now decides they're not going to have people go back to work because they needed to kick us when we were down. Until some of that changes, DC is going to be a really difficult market, but the U.S. is going to be a difficult market. Let's get back to work. It's been 4 years.
So there are two issues. You've got with office, and the difficult ones to solve. You've got a cultural issue in the United States that you do not see in Europe, the Middle East, or Asia in terms of work from home. It's a sense of entitlement that people seem to have in the United States. Yeah. Coupled with, now we have this problem with this, yeah, where we have government spending that's spawned inflation, which, by the way, I think it's probably worth noting for everybody, just in case for those of you that don't pay close enough attention to this, You see the blue line, which is the amount of federal debt that's outstanding. We're at 34.4 trillion as of this week. But the really mind-blowing part, I think, is that we crossed 33 trillion on September 18th. It only took 108 days to cross 34 trillion, and we're on pace to cross another trillion about 100 plus days later. So we're on this unsustainable path of basically having to finance a growing problem that we're in while working our way through the inflation problems.
Yeah, and listen, people think that the Fed chairman is going to worry about interest expense for the government on that 34 trillion. I don't think he cares. That would be a third mandate. He has 2 mandates, and I don't think he cares. So I think they'll be patient, and we may get to this forward curve, but I never thought we were getting to the last forward curve. And you asked me about Europe, I guess my only response to it would be I've never been on a call with somebody at 2 in the afternoon who had wet hair on a Zoom in Europe.
Good anecdotal evidence right there. This tells the story. I mean, we've got personal savings and personal consumption zapped. As people are struggling with inflation, they've drained their checking accounts. Let's skip this just to show everybody you want to talk about.
These people all know pretty much all of this. We've talked about the Fed hikes. I think we can go on.
Okay.
This is interesting. The equity market, which I said is generally wrong, has been right here. The equity market through REIT implied cap rates was moved before the private markets. Hedge funds and others were smart enough to decide that cap rates needed to be wider quickly, and other sectors followed. But I don't think there's much of a story here. What else do we have? So this gets to a lot of the story of what's going on, right? There's very little transaction volume. So we're in opaque markets. We don't know exactly what the right cap rates are or what a cap rate is anymore in office, but there's a lot less to do. There's a tremendous amount of new capital, both on the debt and the equity side. Why don't we skip right to the next one?
Yeah.
We're going to come back to this near the end.
You want to come back to this one? Sure.
And all right, I'll stop here for 1 second. Credit spreads are much wider. Investing in CRE has got very interesting, and investing in securitized CRE has got very interesting, because for the first time you can earn mid-teens, for the first time since zero interest rate policy, you can earn mid-teens on credit bonds that are effectively, this is triple Bs, so you're talking about the 62 to 65 LTV tranche where you can earn 15% plus minus on an unlevered bond position. So opportunity is greater than it's ever been on the mezzanine side of our world, but you are taking into consideration in these, you're going to have 15 to 20% office and other in these CMBS deals. So you have to understand the credits. Fortunately for us, we've underwritten every credit in every CMBS deal ever, so we have an opinion on every deal. Most people who trade these only look at the handful of top loans, but there are landmines. But what's happened here that's interesting to me, in my 30-year career, when rates went up like they did in the last 2 years, spreads tend to come down. And they tend to come down because you have insurance company buyers and yield buyers out there that are being compensated by higher rates. So they're rushing in to buy credit that they think is money good credit, and spreads tend to come down. This caught us all off guard because it's the first time in the last 20 years, probably since our spreads have widened as rates went up. And most of us have hedges on our books, and our hedges probably didn't perform as well as we thought, and we thought that spreads would come in, but this is an anomaly when we look back at history, and it's created significant total return yields. So let's go to the last one on private equity if we can keep going right here. So the guys before talked about private equity dry powder. You have $2.5 trillion of private equity powder. Preqin says today that there's $205 billion of dry powder in private equity firms for US commercial real estate. And there's 260 for international real estate. So we tend to have 500, 550. The record 3 years ago was 600 billion of transactions in CRE a year. This dry powder, just having 200 and change with 3.5 turns of leverage is almost $1 trillion worth of buying power that private equity has on the sidelines. That's almost 2 years of supply if nobody else in this room buys an asset. So I told you earlier how everybody ubiquitously gave their money to Blackstone, and it created a problem because we are all floating rate borrowers on the private equity side. There is a lot of dry powder here, and people are very excited about that. And we're also excited that there are new pockets of debt coming in today to lend. But getting a senior mortgage is more expensive than it's ever been. So if you create a debt fund, you're going to have a much higher cost of funds on taking a senior to create your mezz. So there's not enough leverage to compensate these people. But the problem with this money, why I don't think this money turns the market in the next year, is you can't buy a 5.5 cap asset and pay 7.5% for your debt and not expect to have a 3.5% cash return this year. So you're playing for increases in rent or reduction in cap rates later driven by lower interest rates. But this money loves to spend itself when cash returns are above cap rates. Cash returns, because of negative leverage, are significantly below cap rates. So you have to be much more right now about your forward expectations of cap rates and income than you had to be for the last 12 years. And that makes people pretty nervous. So they're not putting this money to work. We had the quietest year on our private equity side we've ever had last year. We have a tremendous amount of dry powder. But cash returns aren't significant enough, and not everybody wants to make a bet that they know where rates are going to be in 5 years, or that they know that they're going to be able to push income across the product spectrum.
So your theory of the case is you've got this slide showing you've got $2.5 billion dry powder.
$2.5 trillion, but that's all private equity. Real estate, I know the number Preqin is $205 billion in the U.S., but that's $1 trillion of buying power with leverage.
So $1 trillion of buying power. Some in the audience, and we've heard other people talk about, rates have come down from where they were in October. Your theory of the case is it enough to save us from going off the cliff?
Yeah, I mean, fixed rates are down 90 basis points, but SOFR hasn't moved. So you're making a bet that you believe SOFR will go down faster than the forward curve when you take a floating rate versus a fixed rate, but you have negative leverage today. So your 6 cap doesn't earn 6% if it's levered. It earns less. And you just have to be a lot more right. And a lot of us, it was really easy to invest in real estate for the last 15 years. And thank God a lot of us were lucky to be investors in real estate because you had positive leverage and you had to be really wrong on your cash flow to lose. You could miss by a decent amount and still buy a boat.
My favorite quote was, it was like peeing in the ocean. You couldn't miss.
But this is different, and I think I'm not commenting on that, being a public company president. I think it's scary to people to invest without a cushion, and so I don't think this money comes in and bails the market out.
Let's talk about, because we particularly the students in the real estate program, we talk a lot about asset class differences, and we think in the old school format of what's the safest commercial real estate asset class and what's the riskiest. And usually we bookend it with multifamily is the safest, hospitality is the riskiest because you've got nightly leases to put heads in beds. But this dynamic of what's happened over the last couple of years has really taken that and shaken it on up, because now we're talking about asset classes that were different asset classes purchased at more or less aggressive cap rates, financed with, layer on top of that, short-term financing. So in your view, what do you paint as a lender that's sitting on, as you were saying, you're limited on upside, right? You don't have upside, you've only got the downside. So where do you see, if you had to bifurcate, what is risky to you?
Yeah, listen, groupthink has always been a problem in investing across anything, and multifamily is generically less risky. If we finance or buy a multifamily asset at a 5 cap and we expect it to produce a 6.5, 7 debt yield, we're not often off by that much. Rents don't move that much, and we've only seen us be off by more income than less. Expenses are up. But what happened, I think, over the last 3 years is everybody decided that the safest place to be was multifamily. So what happens when everybody decides that? There's more leverage available to multifamily. So you were able to borrow at 80% leverage there when you were only able to borrow in the low 60s on hotels. And ultimately, everybody over-levered their portfolio. They took advantage of a steep curve and zero interest rate policy for 10 years. And there was too much leverage given to that business. So you're going to have a decent amount of distress in the multifamily side. The good news is a poor performing multifamily is still going to run to a 5.5, 5.75 debt yield, even if you missed on everything. If you were terrible, if you missed on insurance and taxes and you didn't upgrade your units very well, and if they're going to trade at a mid-6s cap, like you're not going to lose, no one lost that much money or will lose that much money in multi, but the fact that everybody piled in meant there was too much leverage available at too low of a price. You mentioned hotels, and look, in 2017, 18, nobody wanted to touch retail. Retail's pretty cool now. In 2020, nobody wanted to touch hotels. Hotels are okay. It's not the nightly leases that I worry. COVID, we worried about nightly leases. That was an immediate overnight shock to the system. What I worry more about is operating companies, and hotels, a lot of them these days are trying to drive revenue off their operating company side, food, bev, revenue, et cetera. And in union cities, very difficult to sustain that. Expenses tend to eat it up. It's hard to be cool 2 years in a row. And as a lender, I try to focus on sort of real estate rather than operating company, but I would have rather lent it on a lot of hotels at the low mid-60s LTV if I felt like I knew V than lend on multifamily at 80 because the whole market went there. So I think the lesson would be avoid where everyone else is going and maybe step in where they're not. Except office.
The three asset classes I think of that had the most cap rate compression, multifamily, which you've talked about, self-storage, and industrial. So let's talk about the other two for a second.
Yeah. Self-storage, I was just looking at a deal
multifamily is an
today.
anomaly, right? Because you've got Fannie and Freddie out there. You've got the benefit of the government creating liquidity there under the guise of it's for housing.
Yeah.
But let's talk about self-storage and industrial.
I don't do a ton of self-storage. I was looking at a deal today. It was like 18 self-storage all around the country, and we really started to dig in deep on it. And lease up has been slower, and turnover has been higher, and they're expecting everything to get up to 85% or so. And I'm wondering if what we were talking about before with the consumer, savings are gone, inflation is higher, that there aren't a lot of consumers who are saying, you know what, that extra $225 a month for the locker of grandma's stuff, I need to cut something, and expenses are up, and I'm doing that. So I'm a little bit bearish on self-storage. I think that if the consumer is weak, you're going to see a lot of people who have just been paying that bill every year for 3 years, and they don't realize they've spent more on it than the cost of the 10-year-old couch was worth if they sold it. And I think you're starting to see people give them back. Industrial is the more interesting question. I haven't been in a retail store in 3 years. I do everything on Amazon, and all the last mile is there. Amazon is subletting a tremendous amount of space. But for the most part, I still feel fairly comfortable because it's a fairly full market, and there has been supply. It's not easy to get supply in infill areas. I'm not calling for the death of that market yet, but supply has been massive. The most interesting place to me right now is data centers, and everybody's talking about it. It's the flavor of the day. We've become the 4th largest private data center owner in the world. We've been leaning in pretty hard. We have an energy infrastructure business, so I think we understand the energy dynamics a bit, and it's a big energy driver. But Elon Musk says you're going to need 3 times as much energy by 2045 as you need today. A great tailwind for my energy infrastructure lending business. But a big part of that is electric cars, et cetera, but it's AI. And the parabolic shift, dynamic shift on the AI side, data centers kind of look amazing, but in the same way that I worry about, I never lent on I never lent on sort of lab space office, and we've seen a tremendous growth of that over the last 6 years. And why? Because I'm in for $300 or $400 a foot higher basis, and if it doesn't work, I have to turn it back to conventional office, spend another couple $100 a foot to get half the rents down the line. And I was always of the opinion that we can't triple the amount of lab space in this country without having 3 times as many scientists. And last time I looked, we have the same number of scientists graduating every year, maybe less. So I felt like that was going in the wrong direction, and in some ways it's analogous to industrial and data storage. When we build too much data storage, it's going to be a problem because it's tremendously expensive to build. I just don't think we're there yet.
We've only got another 5 or 7 minutes left, and I don't want to miss what I think is perhaps the most important part that we should talk about and ask you about, and that is this slide here. So let's talk about the health of the banking sector, because ultimately, if the crux of this is we've got a liquidity issue in this wall of maturities that is upon us, and people need to be able to get out, combined with you have banks that have been forced into strange lending behavior over the course of the last decade because of zero interest rate policy. Let's talk about that. So you want to touch on the importance of this slide?
Listen,
there's a lot of info on this slide, so let's distill it to what's the most important.
We have a decent-sized CMBS book. We're a much bigger floating rate lender. This is more to the fixed rate borrower, but at least what you see here is that the lending market has some level of sanity. They've moved LTVs down to 52%, if I'm reading that right, from sort of high 60s pre-crisis into the 60s, post-crisis in the last few years. So the banks are certainly tightening their belt on the amount of capital they're willing to give from a loan-to-value perspective, and they're requiring a much higher debt service coverage. So this is also pushing people from the fixed rate market to the floating rate market, by the way, because it's much more difficult to get a fixed rate mortgage when you need a 2.5 to 3.
Multifamily, self-storage, industrial, fill in the blank at a tight cap rate with a long-term fixed rate loan that's got all sorts of bells and whistles that you can't prepay once you achieve your dream of your pro forma. So everybody went to floating rate.
Yeah, it's difficult. Every time, I always wonder about this math. Every time a loan rolls, I'm seeing a new loan to take out the old loan. Everybody wants to take cash off the table. We rarely allow that. But the new loan to take out the old loan was $75 million, and they're coming for a new $80 million loan. There was no principal repayment over the course of the loan, and floating rate market is IO, so the $75 million loan is still 75. And they're putting all the fees and expenses for the new loan into this one, so now I need 80 to pay off what was 75. So the loan balance actually keeps going up, as opposed to the way it's supposed to work is there's supposed to be some amortization. You're supposed to have some principal pay down. The world needs to get away from 80% IO loans and the floating rate market being all IO, and it'll deleverage the real estate market, but it might be a good thing to take some of the froth out of the market by actually having people need to take a smaller loan next time than a bigger loan, or at least paying the bank down a little bit. We've got away from that, and that used to be where we were when there were more sane markets. But this is making it very difficult to replace the amount of leverage that you have when you need a 2 to 3 debt service coverage ratio and only getting 52 LTV. This slide, if I had to distill it, because there's a lot of information on here, and I was the one who drew these boxes. I'm dizzy looking at it.
I know, it's like a weather map. But the story, it's telling the story of what's happened in CMBS, but simultaneous with that, it also tells a similar theme of what happened in the banking world. You have, I focus on the debt service coverage ratio, and you went into 2008 in the great financial crisis at tighter debt service coverage ratios than where we are going into the debacle that we're in now. But that leads, what that means is that borrowers are able to bleed out longer because they had lower leverage at coupons that were 3.5 to 4.5% versus going into 2008. They had coupons that were in the mid fives to high fives. So, whereas before when we hit the wall in 2008, 2009, people they had term loan defaults. They didn't get to the maturity, they defaulted before it. Here it's a long bleed because people can limp along a lot longer with low debt service. So what does that mean for the banks? Do we have a banking crisis that hasn't yet come to full fruition?
So the regional banks are a problem, and 77% of loans get made by the regional banks to Americans, and that's number of loans, not dollar of loans. So we need, every congressman has a regional bank in their district, and so they're all fighting for better rules for the regional banks. The SIFIs, the structurally important financial institutions, are held to different standards. They have to fixed rate hedge their loan books and do a lot of things, and the regional banks get away with a lot because I think everybody in the Congress and the Senate is protecting their local regional bank. And so you've created this, looking after Silicon Valley Bank. I'll give you an example. Barry Sternlicht, my CEO, came in, stood behind me in my office the Friday afternoon after Silicon Valley announced the day before, and we started talking about First Republic Bancorp. And he showed me their balance sheet. Book value was $79, stock was trading at $77. Where do you think it's going to open on Monday? What's the balance sheet worth? And over the next couple hours, I created a model. I kept one of my guys in, and we stayed in the office for most of the next 36 hours. And I called them on Sunday morning, and I said, I've run 17 or 16 regional banks, and they are all insolvent to liquidation. How is that? Well, every bank is about 10 times levered. So once the value of your loan book goes down by 10%, your equity is gone, right? That's sort of easy to think. But the SIFIs have interest rate hedges against their book, and the regional banks are allowed not to, and it's insane. So if I look at First Republic on that day, they had a $160 billion balance sheet. 102 billion of it was residential mortgages with a 2.97 average coupon, and then it was commercial real estate and other things, and they only had a $6 billion pay fixed hedge with home loan banks. So they had a $160 billion fixed rate loan book that was only hedged $6 billion. So they were long $154 billion of rates, call it a 5-year, and rates just went up 200 basis points. That's 10 points gone, game over, you are structurally insolvent. He said, well, how bad is it? I said, well, when I take out deferred tax assets, which are no longer an asset when you're not going to have income in liquidation, take out PP&E, because just because I spent all this money on computers doesn't mean I can sell them for more than 5 cents on the dollar. Take out goodwill, big part of a lot of these banks' balance sheet. It's worth zero when you're in liquidation, and you now mark the books down based on the duration to somewhere in the low to mid 80s, and we were trying to look at all of the loan characteristics we could, but our best guess at the time was low to mid 80s. I got negative $102 a share liquidation value of First Republic, which was trading at $79. So it comes down to, does the government, does the Fed want to keep the regional banks and the supplier of 77% of the loans in the United States? And I said they do, is my supposition. That would be a terrible day. And so the decision we made on Sunday was that the Fed would come out by Monday morning and offer a program to make sure that everybody had liquidity to be able to cover.
That program, by the way, which, if I'm not mistaken, I'm going from memory, but I think it expires in 60 days. So what's your call? You think they're just going to re-up it?
Not many people used it. It was the existence of it that gave people some hope that things would be okay. It wasn't that it was actually drawn, because if it was drawn, you were inviting the regulators to live in your office for the rest of your life. And a lot of people decided not to do that. But the existence of liquidity is what mattered. And I think we'll keep up the existence of liquidity so we don't force these guys, because there's no way to make them positive liquidation value unless you bring rates back to where they wrote these fixed rate mortgages. So until rates go back to where they were, you can't afford to hedge these books today. You don't have enough income to hedge the books. You're looking at your watch, we must be done. And so it's gonna be a while. I actually ran into Lloyd Blankfein that Sunday afternoon. I went to some golf balls, and Lloyd was the head of Goldman Sachs, and I explained what I had just gone through. And Lloyd said, Jeff, we need to go back to mark to market. And I said, but we can't until rates go back down. So if Jerome Powell, to my previous supposition, actually cares about the 34 trillion, he would lower rates. If he cares about the regional banks, he will lower rates, because it's a big problem in liquidation. But I'm not saying it's going to be a problem, because I think they will make liquidity available to keep them around. But it's created a great opportunity for me. I created a middle market lending business on the back of this. We typically write loans over $100 million per loan, and now we're starting to write loans from sort of $20 to $50 million, and we can earn a lot more spread and earn a much higher levered return for our shareholders. So we're trying to fill in the gaps of what the government's giving us.
All right, last question, and we'll make this really quick. Last couple of questions. So this is geared towards those, we've got 59 students that are in here today that are all heading towards walking and graduating in May. So let's start with, where'd you start coming out of school?
Oh boy, I I grew up in a three-family house with a single mom, and I worked. I was on work study, and I left high school every day at 11. I never took a book home. I was a terrible student. I got lucky. Something really important happened. My guidance counselor, who had to meet with me, told me to take the SATs, and on the back of that, I found some programs and was able to go to college. But when I got to college, I realized that there were a lot of people who lived in a different world than me, and that was really interesting. And I started to work hard. And for these young kids, you don't have to start on third base, but if you decide that you want to be in one of these seats of these adults, be the hardest working person in the room, in every room you're in. Never be outworked. And what that's going to do for you is you're going to get some percentage of you will get lucky because of it. Because anybody who thinks they're as successful as people in this room without luck is lying. Or we've all been tremendously lucky, but luck finds people who work hard. And young kids I have 4 of them, and they're millennials, and they don't work the way that we used to, and you guys can take a lesson from people like me. I look at a lot of resumes of kids. The other thing I would say is I hate when kids move around a lot. It's really easy to shift jobs because you don't really like your boss. Things aren't going that well. My friend is making more money at this internet startup. I love to look at a resume and see someone's been there somewhere for 6 years and have them tell me a story. It was terrible, but I found a way. I figured it out, and I stayed with a company. Don't leave until there's an opportunity so good that it makes sense to leave. Young kids decide every year they should have a different job, and old people like me hate looking at that resume and will not give the time of day to a lot of those people. And having the fortitude to stick through things is really important, and that's what I want in the guy next to me. So my thing would be figure out how you're going to tell a story based on your past, based on what you've done, that nobody's going to outwork you, and you'll have a great opportunity.
So work hard and don't work from home.
Don't work from home.
Yeah. Thanks very much.
When COVID hit, Barry lived down the street from me in Miami Beach. I spent 28 or 29 days every day, 7 days a week, from 7 a.m. till about 9 p.m. We were on his kitchen table. We had a few assistants with us in that first month of COVID. And then thank God I went back to New York, so I started doing it. I worked one day from home, and I called my secretary in and all of my reports. I don't know how people do it. In a stressful business, in a stressful world, this work from home thing couldn't make less sense to me, and I think we should all be pushing back really hard. We're teaching terrible things to the next generation. Our kids all expect it now. It's wrong. Go to the office, be more productive, be social, learn from adults, train people. It's crazy. We're going to lose our competitive edge in a lot of ways. Our 12th graders read like 8th graders, and our adults don't go to work anymore. So we have got to change that.
Great. Thanks so much for making the trip here.